Good morning, everyone. I'm Adam Myers and I lead the distribution team at Pengana. Thank you for joining us for this webinar update with Amy Pham, Portfolio Manager of the Pengana High Conviction Property Securities Fund. This fund is the most recent addition to the Pengana lineup. It was only established just over a year ago, but it is managed by two very experienced fund managers with great track records. Amy previously managed the High Conviction Property Securities Fund at Charter Hall. She has also won a number of industry awards, including Financial Standards Property Manager of the Year in both 2017 and 2019, and the Money Management Australian Property Securities Fund Manager of the Year in 2018. Amy is also well aligned with her unit holders. The majority of her own wealth is invested in this fund. She is supported by Jade, who has over 17 years of experience in corporate finance and property funds management. Today, Amy will take us through her current positioning and her outlook on the sector. During the presentation, if you have any questions, please enter them in the question box, which can be accessed from the icon on the bottom of your screen. We'll get to as many as possible in Q&A at the end. Amy, over to you. You're still on. There we go.
Thank you, Adam. Good morning, everyone, and thank you for joining us today. Before I start providing an update of the fund, I'd like to highlight the key drivers of our strategy. We are a high conviction fund with an ESG focus. The reason for adopting a high conviction strategy is that the index is highly concentrated, with the top 8 making up more than 80% of the index. Not only that, if you dissect the diversified sector more, it is very weighted towards the retail sector. By us investing outside of the index, it provides us with not only diversification, but it also allows us to invest in new growth opportunities such as data centers, manufactured home estates, and childcare. We believe that by incorporating ESG alongside with financial factors will provide us with more complete risk-return profile of our investments. It is also becoming a requirement of many investors, such as non-for-profit industry funds and family offices. Turning to alternative assets. This is where we see the most opportunities and growth over the next 5 years. So what is alternative assets? Alternative assets is classified as anything that lies outside of your traditional core assets, such as retail, office, and industrial. It is usually driven by secular trends such as urbanization, e-commerce, and aging population, driving demand for assets such as manufactured housings, data centers, and retirement living. The key benefits of including alternative assets is that it provides diversification, it is less, has less cyclical earnings, and also has longer lease terms. For example, in childcare, the average lease term there is about 12 years. In service stations, it's about another 12 to 15 years. And in data centers, it's about 10 years. In Australia, alternative assets only make up about 6% of the index. This is compared to more matured markets such as in the US and then in the UK, where alternative assets make up more than 50% of the index. We think that Australia will follow this trend as more capital is being allocated to the sector, with retail being out of favour and industrial assets are becoming increasingly competitive to get good assets. Over the next couple of slides, I will take you through each of the assets, such as retail, office, industrial, and alternative assets. We look at the macro and thematic drivers of these, also how the performance of these assets during COVID and how we're positioned. Now, the retail sector has definitely being the hardest hit during COVID, with store closures and rental abatements. A year on, and things have improved dramatically, with foot traffic and rental collections back up to near pre-COVID levels. So where to from here? We expect retail sales to be strong, driven by recovery in the labour market. But this is offset by the roll-off of some stimulus, and also as the economy reopens, the redistribution of sales away from goods and into more entertainment and travel. And of course, the structural shift continues as online retailers taking more market share from the bricks and mortars. At the moment, the online retailers represent about 11% of total sales in Australia. Now, this is expected to increase to 20% over the next 5 years. So how has these assets performed? Foot traffic for most centres have recovered to pre-COVID levels, except for CBD assets where foot traffic is only about 60%. Occupancy remains high at 98%, while MAT, which is moving average turnover, is improving but still down by 5%. This is dragged down by the specialty sales and department stores, while supermarket, DDS, and also the mini majors are very strong. So how does this translate to operating earnings? We think that cash flows remains under pressure because of the negative rent reversions of as high as 12 to 15% to continue over the next 3 years. Vacancy levels were expected to rise on the back of unwinding more lenient insolvency regulations and the roll-off of fiscal policy. More and more, we are seeing defensive capex to protect market share from online retailers instead of spending to expand their earnings. So as a whole, we remain underweight the retail sector and expect the valuations to decline a further 10 to 15%. In office, we expect that as jobs and unemployment rate recover, there'll be more demand for office space. However, this is offset by the high vacancy rates of 12% for Sydney and 13% for Melbourne. And also the uncertainty of the working from home thematics. So how has office assets performed over COVID? It seems to be quite strong and resilient, with rental collection at 96% and occupancy remained at 95%. However, physical occupancy is low at under 50%, and lease term is unchanged at 5%. We expect that the secondary assets to be the most risk, as with the uncertainty of working from home and also the high vacancy rates, tenants would take the opportunity to reduce the existing space but upgrade to higher quality space. During COVID, the market was looking at the hub and spoke model, hub being the CBD assets and spoke being satellite offices spread around the city. 12 months on, and we think that the hub means the CBD and spoke is home. Industry feedbacks have shown us that the working from home thematics is going to remain, and that most likely most employees will spend at least 1 to 2 days working from home. A few of the larger landlords had conducted a tenant survey, and it showed that 50% of their tenants intended to stay where they are, while the other 25% wants to reduce space, and the remaining 25% wanted to increase space. Notwithstanding this, the impact of working from home valuation is supported by offshore demand and transactions at or above book value. The risk for the office sector is on the upside, as the feedback from the market tells us that the inquiries from SMEs have been improving, and also net absorption rates have improved. This is consistent with the JLL data, which showed that at the peak of the pandemic, back in June last year, the net absorption rate was minus 95,000 square meters compared to, as of March this year, net absorptions was at minus 7,000. Now, the industrial sector is a clear winner from COVID and is continuing to see strong demand from e-commerce tenants, along with capital still chasing the sector from both domestic and global players. According to Colliers, for every 1 billion spent on online retailers requires 85,000 square meters of warehouse space. They're also forecasting that online sales is to grow to 12 billion this year, which would result in 1 million of square meters of warehouse space needed. Putting all this together, we think that the like-for-like rental growth will be around the 3 to 4% mark, and that further cap rate compression of 100 basis points is to be achieved over the next few years. This is based on the recent transaction of the Milestone portfolio, industrial portfolio, which was transacted at a cap rate of 4%. Alternative assets are attractive to us for the following reasons. Its earnings is less cyclical as it is driven by secular trend. Social infrastructure assets such as childcare and retirement living are supported by the government. For example, during COVID, childcare was provided for free for essential workers. And in the latest budget, the government had announced an extra 1.7 billion supporting the sector. Whilst online retailing and working from home is hurting the retail malls and the office sector, it is benefiting the logistics, data centers, and self-storage. Similar to industrial sector, we are forecasting like-for-like income growth of about 3 to 4% and further cap rate compression in the market as it matures. Putting all this together, as you can see from the chart above here, that by diversifying away from the index and investing in alternative assets, we're able to provide more diversification in terms of the sector. And alternative assets is making up 20% of our fund compared to the index of 6%. Here are some key stats for the portfolio. Not only that our portfolio is diversified in terms of the sector level, but also at the stock level. The top 5 holdings of the fund makes up 41% of the fund, whereas the top 5 holding of the index is 61%. We also have 20% exposed to alternative assets. We have a highly concentrated portfolio with a maximum holding of 20 stocks versus out of the index of 50. And normally we would hold around about 10 to 15 stocks in the index. We're able to preserve capital with maximum drawdown for the fund at minus 16% versus the index of minus 35%. And we provide higher than average income yield of 4.6% versus the index of 4.3%. Looking at each of the stock examples. Ingenia is a residential developer with 60% of its earnings from manufactured home estates or land lease businesses, while the other 40% is from holiday parks. For those of you who are not familiar with the MHE model, this is where Ingenia sells these manufactured homes to retirees and also receive a monthly rent of the leases. This provides the retirees to be able to, with low savings, to be able to release equity for their retirement. Through COVID, the MHE model has been quite resilient, and in fact, with broader closures, have benefited their holiday parks with people holidaying at home. In the last few years, they've been able to achieve double-digit earnings through growth with strong development margins of about 32%, which indicates the strong demand for their product. We expect this earnings growth to continue with strong thematic drivers coupled with strong balance sheet to drive growth through acquisitions and development. Even though they don't have a neighbours rating, they have adopted good sustainable initiatives through the rollout of their solar energy and installation of LED lightings across their holiday parks. Cedar Woods is a residential developer focusing on land and townhouse development across Victoria, Western Australia, South Australia, and Queensland. They've reached a record sales level driven by the low interest rate environments and government stimulus, with most of their products eligible for the home builder and first buyer grant. In Western Australia, at one point, first home buyers were able to get as much as 50,000 in grants, which is quite substantial when you think that the average lot size costs around about 250,000. One of the key driver of performance for this stock is that it has very high pre-sale numbers of 330 million, providing strong earnings growth visibility while its strong balance sheet enables it to acquire and sustain development pipeline. Turning to Scentre Group, because the index is highly concentrated, you can add value from not only holding a stock, but also not holding a stock. So in this case, the portfolio do not hold Scentre Group while the index weighting is 9%. Now, the key driver of this is that we think that earnings for these large discretionary malls is going backwards because of the continued structural shift towards online retailing. Rent collection for Scentre Group has been averaging about 80%, but with the negative leasing spreads of 12%, we think that there is going to be a step down in the earnings. We're forecasting that total return for Scentre Group would be about 10%, which makes up about yield of 5% and growth of another 5%. The balance sheet is quite high gearing if you consider the latest notes to be part of gearing, where we think that this could be a problem because a lot of the capex for their centres has been to protect their market share instead of to grow earnings. NextDC. Now, NextDC is an operator and owner of data centres across the major cities of Australia. NextDC is the only pure-play data centre operator that is listed in Australia. It is leveraged to e-commerce growth and adoption of the cloud. It has a strong record of delivering revenue and customer growth of 20% over the last 5 years. With the rollout of their S3 and M3, it will increase their capacity to 175 megawatts. Now, as you know, data center is the biggest user of energy, but NextDC is very focused on sustainability of its centers with neighbours rating of 5. Now, I'd like to take you through an ESG case study. For each of the E and the S and the G, I'm going to take you through what we look for and then refer back to the Mirvac, what Mirvac has achieved. So in the environment, we look at for environment, we look at the water and energy efficiency. We also look at if they're a developer, we also look at their waste management and most importantly, their carbon emission targets. So Mirvac on environment ranks well. It has a 5-star neighbours rating with carbon emission goal to be net positive by 2030. And the outcome of this is that they have reduced carbon emissions by 80% since 2014. And if you look at their sustainability report, you can see that they have built the first apartment made out of waste. On the social, we look at how the company treats its employee, its customers, and also its supply chain. Here we measure the employment engagement and also diversity and of women in the workforce. Mirvac ranks well under the social with 90% of employee engagement, which is very high compared to its global peers. It has diverse workforce with its female being its CEO being a female, and their employees speaks over 35 languages. It also invests in more than $100 million to support social sector by 2030. And as a result, it is ranked #1 in the Asia Pacific region for gender equality. And through its build to rent projects, it addresses the housing affordability issues. For governance, we look at the composition of the board. We also look at the adoption of sustainable norms of code of conduct, and also, more importantly, whether the board is responsible for ESG factors. As you can see from there, the governance is ranked very highly for Mirvac for us, because it has a very clear scorecards for each of the business units in terms of the E and the S and the G. Looking at performance, the chart on the left-hand side showed that the cumulative return since inception. And then on the right-hand side, it is the rolling monthly return for the fund since inception. As you can see there are 3 periods where there's huge, great performance that from the fund. So starting from March, which is in the peak of the pandemic, the index fell 35% versus the fund of 16. Now, this is a time where we outperformed the index, mainly because we didn't have any exposure to the large retail malls, such as Scentre Group, Vicinity, or Unibail. We also adopted a very conservative portfolio, whereby for retail, we were exposed in mainly just the supermarket-based retail. And then for office, we were exposed to more metro at REITs with long WALE. And then the next period was in April 20, when the government started to announce their stimulus, and that is when the index rose 14%. And then in November, when you had the reopening trade with the announcement of the effective vaccines, the market rotated back into the sector with the index outperforming by 13%. So as you can see there, since inception, the fund has outperformed the index by 18%. I think that looking back, the fund has done what it's meant to do, which is to provide capital preservation, income yield, and sustainable earnings. So with this, I'm going to hand you back to Adam for question and answer.
Thanks, Amy. That was great. We have got a few questions, and the first question is the one which we probably should have anticipated. Everyone is talking about inflation at the moment. What will that mean for investments in the sector and specifically in your portfolio? Please, can you share your views on interest rates as well?
Well, our view is that interest rates would likely rise to about 1.9 in Australia and about 2% in the US. Now, obviously, for a rising interest rate environment, we expect that the sector will underperform as investors rotate out of the more defensive sectors and into cyclical sectors. Now, even though bond yields have risen quite sharply, it is still very low when you look at it over a period of 20 years. So we think that with this low interest rate environment and low for longer interest rate environment, we think that the sector will be still supported. And then to your second question about inflation, well, you can argue that property is a natural hedge to inflation, with a lot of the leases are written with at CPI leases. So, we are looking at very closely. We think that at the moment, because where wage growth is, we don't really see that inflation is a problem, but we are monitoring where inflation sits in over the next few years.
Great, thank you, Amy. The next series of questions relate to ESG. So perhaps you can start by taking us through how you incorporate ESG into your process. And while you are answering that question, perhaps you can also give us an example of a REIT that was screened out because of the ESG process.
Sure. So I'm going to take you to this slide and I'm going to talk you through it. So we start with a universe of about 51 stocks, and we screened out based on what we consider to have poor corporate governance. We only screened out one stock that we consider to have poor corporate governance, and that is Eureka Group. And the reason for this is that one, it has a lot of changes in the past few years of its executive team. The board doesn't, because of all these changes, it doesn't seem to have a very clear strategy. And also it has a lot of problems with related party transactions in the past. And that is why we screen it out. And then the way that we incorporate ESG is that we build an in-house questionnaire, ESG questionnaire, which we send out to our investable universe. And the key benefit of this is that it allows for the smaller cap stocks to participate, even though they don't have the capacity to be ranked by a third party, such as Sustainalytics. And it also allows us to engage with management and have a better understanding of the ESG issues. Now, we think that we rank the ESG alongside with the financial measures, and ESG makes up about 30% of our valuation process. We mark down any stocks that has an exposure to its income from unethical sectors such as gaming, tobacco, alcohol, and fossil fuels. And the reason that we incorporate this is that it provides a better risk return profile for our investments, and also it identifies companies that would generate more sustainable earnings.
Great. So governance is obviously important in any corporate structure. What particular importance do you attach to the E and the S, in ESG?
Yeah, well, it's made up of a total of 30%, the ESG, so it's 10%, 10%, 10% equally. And when we talk about the income that is exposed to the unethical sectors, it is if any of the REITs that has more than 10% of its earnings to these unethical sectors, we will mark it down on the E and the S.
Okay, makes sense. Thank you. Next question: alternative assets comprise 20% of your portfolio at the moment. Are you looking to increase that even further?
Sorry, Adam, what was the question?
Alternative assets currently comprise 20% of your portfolio. Yep. Are you looking to increase that even further?
Well, it just depends on the opportunities. I think that going forward, a lot of the large REITs are looking at expanding their exposure to healthcare, build to rent, like for example Mirvac, and data centers as well. So it just depends on when these assets are listed, and also the availability of those. But yes, we like the sector, and definitely we look to increase our exposure.
Great. I have a question here about shopping centres. Does Scentre Group sort of reflect your view on that sector, or are there differences that we should be thinking about, and what are they?
Well, obviously for retail, there's the large retail mall owners such as Scentre Group and Vicinity and Unibail. Well, Unibail is more global, so it's different. But and then you have the ones that are more exposed to supermarket and DDS, and they're called sub-regionals. And then lower than that, you have just supermarket based centres. So there are different types of retailers, but at the moment where we see that the large discretionary malls are the one that is going to be the most impacted by online retailing, and that's where we're underweight in.
Makes sense. And can you just talk a little bit about your approach to investing in infrastructure and G-REITs?
Look, we can, in our mandate, we can invest up to 10% in G-REITs and also real estate related businesses. So we can invest in it, but at the moment, we've already got a lot of opportunities within our universe compared to the index. So the index has about 30 stocks and we have about 50 stocks. So, we think that we have enough opportunities there within our universe. As the fund gets bigger, then, we would consider expanding that universe to infrastructure and G-REITs.
Great, thank you. What seems to be one of the last questions, can you talk about your investment in Charter Hall Group?
Sure. We've been holding the Charter Hall Group as one of our core holdings. This is because we like the business. They are definitely one of the best fund managers in the sector. They've been able to grow their FUM at a rate of, average rate of about 30%. And they are also exposed to, a wide range of investors, ranging from retail, wholesale, and listed. So, they're very and also they're very confident in their ability to develop assets for their tenants. So, you know, their working capital is at about 6 billion, which means that, you know, they're able to deploy that into accretive developments to add more to their earnings going forward.
Makes sense. And can you tell us a little bit about, firstly, the amount that's currently the current assets of the fund and the capacity of the strategy?
So the fund is sitting on about 6 million, 7 million, something like that. And the capacity of the fund is 1% of the index, which equates to about 1 billion. So, you know, we've got a long way to go.
We have indeed. Great. And the last question is, can you explain the return profile that investors should expect in terms of the split between income and capital? Will there be any franking credits, etc.?
No, that for property, because a lot of the REITs, you know, distribute but 100% of their earnings. So, you know, franking credits is very small, small proportion of it. So, you know, because of our strategy is to preserve capital and provide income yield, when the index, you know, is up, you know, 20-30%, we tend to underperform slightly, but then, you know, when the index is down, like when it did back in March last year of 35%, we tend to perform much better than that. So over the long term, I think our upside capture is sitting at about 80% and downside capture of 50%.
Okay, and the capital income split that investors can expect?
So the capital income split, you're looking at capital of about, let's start with income. So income at about 4.5%, and then capital of about another 3 to 4%.
Okay, great. Thank you. Well, ladies and gentlemen, thank you very much for joining us for this update. I hope you managed to get a sense of why we are so optimistic about the prospects for a benchmark unaware high conviction fund in the sector, particularly in the current environment. Our next webinar in this series is next Tuesday with Fred Pollock from the Pengana Private Equity Trust, PE1. You can register for that and the rest of the webinars in the series on our website. If you have any other questions, please get in touch. We'd love to hear from you. Thank you very much and have a good day.